You see those financial headlines flashing across your screen. So often they shout about profit growth for big companies. But have you ever stopped to wonder what's really driving that number? Is it companies suddenly selling dramatically more stuff? Or is there something else entirely happening below the surface?
That's a fundamental question, yeah. In understanding the health of businesses, revenue, the top line, that's usually the engine of growth. If that's sputtering, but profits are still moving forward, well, it tells you the story isn't about booming sales. You have to dig deeper.
And digging deeper is exactly what we're doing today. We're taking a deep dive into the recent Q4 of India's fiscal year 2025 and the full year that just ended in March, FY25 earnings for Indian corporates. Our guide is a detailed report from Nuvama Institutional Equities and gives us a really clear picture, I think, of what's going on.
Absolutely. This report provides the hard data and, importantly, the analysis to cut through the noise. It helps us see the underlying trends and sort of what they imply.
Think of this deep dive as your essential shortcut to being well-informed about the current state of corporate India. You know, what the numbers mean, what the key trends are, and maybe what challenges lie down the road.
And the report has a distinct main takeaway, a core theme that emerges pretty strongly. The modest improvement we saw in profits, well, it wasn't powered by revenue growth.
Right. The real story, according to Nuvama, is something quite different. It's about companies becoming incredibly disciplined, laser-focused on managing their expenses. They call it aggressive cost rationalization. Suggests they are primarily protecting their profits by spending significantly less. Okay, let's unpack how they reach that conclusion. So starting with the big picture, what do the overall numbers for the full fiscal year 2025 show for Indian corporates?
Okay, so looking at the BSE 500 index, that's, the 500 largest companies listed in Mumbai, gives us a broad market view. And excluding the oil marketing companies, OMCs, because their specific dynamics can sometimes distort the overall picture, for that group, profit after tax, POT, growth for the full fiscal year FY25 was, well, a rather weak 9% year on year.
9% for the year. Okay. How did the most recent quarter, Q4 of FY25, look? And just to be clear for you, our listener, FY25 in India runs from April 2024 to March 2025. So Q4 FY25 is that January-March 2025 quarter.
Right. Thanks for clarifying the fiscal year. It can get confusing. So for Q4 FY25, TT growth for the same group saw a modest improvement. It ticked up to 10% year on year. That's slightly better than the 8% growth we saw in the previous quarter, Q3.
Okay, so a slight bump in the final quarter, but the full year number.
Yeah.
Yeah, 9%, definitely not suggesting explosive growth. This is where it becomes particularly interesting, I think. If profits are growing at 9–10%, what was happening with sales, the top line?
This is the striking part the report highlights. The top-line revenue growth remained weak. It's been stuck around the 8–9% mark for a remarkable 8 consecutive quarters.
8 quarters. Seriously.
Yeah.
So 2 full years of essentially stagnant sales growth at that 8–9% level.
Precisely, yeah, a consistent pattern.
That immediately poses a question for you, our listener. If companies aren't seeing a significant acceleration in how much they're selling, but their profits are still managing to grow, even modestly, where is that profit improvement coming from? The report seems to have a clear answer.
It does. The primary driver, the report concludes, for that modest improvement in profits is aggressive cost rationalization by Indian corporates.
Companies are really tightening their belts then. Is there a specific area the report highlights where they've been cutting costs most aggressively?
Yes, a key example given is the wage bill growth for BSE 500 private sector companies. It slowed sharply to just 5% year on year in Q4 FY25.
5% wage growth. Wow, that sounds notably low. A post-COVID low, according to the report.
It is, yeah, and this isn't just in one or two sectors either. The report indicates this cost-cutting, including likely on employee costs, is seen across significant parts of the economy like BFSI, banking and financial services, IT, and the consumption sector.
Okay. And beyond cost-cutting, did anything else give a slight boost to that Q4 number?
The report does note that a low base from the same quarter last year, Q4 FY24, that also contributed somewhat to the year-on-year growth figure for Q4 FY25.
Okay, so a bit of a mathematical boost from a weaker quarter last year, sure. But the main story is companies managing their costs, especially those wage bills. So what this picture tells us is that corporate India is protecting its bottom line not by dramatically increasing sales, but by simply spending less money to run their operations. It's efficiency born out of necessity, perhaps, when demand is weak.
That seems to be the implication, yeah. But this cautious approach, it has another significant consequence, one that the report flags as a major concern, a worrying slowdown in capital expenditure, or capex.
CapEx, right? That's companies investing in their future, building new facilities, buying new machinery, that sort of thing.
Exactly, investment in physical assets. And the report finds that despite companies generating strong operating cash flows, the cash their core business activities bring in, their capex growth has weakened significantly.
How big is this slowdown? Are we talking a minor dip?
No, the numbers are quite stark, actually. Capex growth for India Inc. slowed dramatically to just 6% in the second half of FY25, H2 FY25. And you need to contrast that sharply with the robust 20% plus growth rates we saw in both FY23 and FY24.
Wow, that's a massive drop from over 20% down to 6%. So they have cash coming in from operations, but they're not reinvesting it at anywhere near the previous pace. That feels like a paradox.
It is a bit of a paradox. The report shows operating cash flow, OCF, it moderated slightly in FY25 to 11% year on year. But that's still healthy. It's outpacing both top line and EBITDA growth. So cash isn't really the issue. It's how it's being deployed, or rather, not deployed. It's not being fully reinvested into expansion projects.
And the report links this slowing capex directly back to the subdued demand and weak top-line growth we just discussed.
Yeah, that's the direct link they make. If demand is weak, and maybe companies aren't even utilizing their existing capacity to its fullest, there's simply less incentive to invest in building more capacity for the future.
Yeah, makes sense. Why build a bigger store if the one you have isn't full? What's the broader implication of companies pulling back on investment like this?
Well, this is the concern flagged in the report. This slowdown in private investment, it kind of reinforces the economic uncertainty. It can create a sort of feedback loop. Weak demand leads to low investment, which in turn can perpetuate slower economic activity. And it also poses risks to future earnings growth. Less investment today could mean less potential for expansion and innovation tomorrow.
This dynamic where companies are sitting on cash but not investing, it connects to an interesting economic concept, doesn't it? Often called the paradox of thrift.
Precisely. Yeah, when you combine strong operating cash flows with weak capital expenditure, companies end up generating very high free cash flows, or FCF.
Free cash flow.
Yeah.
That sounds like a good thing on the surface, doesn't it? Companies having lots of cash left over after running their business and investing.
On one level, yes, high FCF is positive. It supports market valuations because it means the company is efficiently converting its profits into cash. Cash which can theoretically be returned to shareholders or used for acquisitions, things like that.
Okay, so that's the good side. What's the paradoxical, the downside?
The paradox is that when this happens across a large number of companies, simultaneously, when they collectively save cash instead of investing it back into expansion, hiring, or new projects, it can actually dampen broader economic activity. Like everyone saving during a recession. Individually sensible, but collectively it reduces demand and investment overall. The report suggests this situation could potentially limit the long-term earnings potential for corporate India as a whole.
So the very financial discipline and cash generation strength, when it leads to reduced investment, can actually be a signal of underlying economic weakness and a potential cap on future growth.
That's a really interesting point. Okay, moving from the aggregate numbers. The report highlights that beneath the surface, there's a significant shuffling happening between sectors. They describe it as a profit churn, where the leadership in terms of earnings contribution is shifting around quite a bit.
Yeah, what's fascinating here is how quickly the picture changed from one year to the next.
Yeah.
The sectors that were, powering growth in FY24 aren't necessarily the ones doing so now.
Give us some examples. Which sectors were the stars in FY24 but are kind of slowing down now?
Well, the report points to sectors like autos and industrials. They were strong leaders in FY24, absolutely, but their profit growth decelerated noticeably in Q4 FY25. For instance, domestic auto peak growth. It slowed from 11% in Q3 to just 5% in Q4. And industrials and infrastructure saw a really sharp drop, from 16% growth in Q3 down to basically 0% in Q4. 0% profit growth for industrials in Q4, after being a leader. Wow, that's a dramatic shift.
It is. BFSI profit growth is also tapering off. That's partly because the benefits from lower credit costs seen previously are normalizing, and credit growth itself is moderating. Private banks, for example, reported negative 4% PPAT growth year-on-year in Q4, minus 4%. Real estate is also mentioned as decelerating, and even some areas of high-end consumption, like hotels, passenger vehicles, jewelry, they're showing signs that their strong profit growth is slowing down too.
So the previous high flyers are hitting some turbulence.
Yeah.
Which sectors then were perhaps lagging but are now gaining momentum, picking up the slack?
On the other side, metals and mining saw a significant improvement. Their Q4 PPIC growth hit 31% compared to just 6% in Q3. Big jump. Chemicals also logged good improvement, with Q4 PIPA growth at 29% versus a contraction of a -6% in Q3.
Okay, strong rebound for chemicals and metals then.
Yeah.
Interesting.
Yes. And cement profitability. It seems to be bottoming out after a tough period. It improved in Q4, showing 3% PPD growth after a substantial, -43% contraction in Q3.
Right. And were there any sectors that just showed resilience throughout, regardless of this churn? Kind of steady eddies?
Telecom continued to show very strong growth,
Yeah.
reported 164% PIT growth in Q4, though that often reflects specific company dynamics, mergers or pricing. Pharma also remained pretty resilient with a healthy 16% PIT growth in Q4.
Okay. So it's a complex picture underneath the headline numbers, definitely. A
Okay.
significant reshuffling of which sectors are driving profitability. It's clearly not a uniform trend across the board.
And this churn and the source of that profitability, cost-cutting rather than sales growth, it leads us to the next key point the report makes, which is about profitability margins.
Margins, right? That was a big part of the post-COVID recovery story, wasn't it? Companies getting more profitable per unit of sale.
Exactly. The initial profit recovery post-COVID was significantly driven by margin expansion. Companies became more efficient, maybe input costs were favorable for a while, perhaps they had some pricing power, but the report states that margin expansion basically stalled in FY25.
Stalled. And in many sectors are now operating near their historical highs in terms of margins.
That's what the report points out. Yeah, sectors like industrials, pharma, autos, consumer services, IT, energy, they're already operating with profit margins very close to their peaks over the last decade or so.
Okay, so they've likely squeezed about as much efficiency and pricing power as they can for now. What challenge does this pose going forward?
Well, the challenge is that with margins already at these elevated levels, achieving significant further expansion becomes very difficult. It's a harder climb from here. It would likely require a strong pickup in demand, allowing companies to leverage their capacity better, or perhaps significant external tailwinds, like a big drop in global commodity prices, oil prices, for example.
And if those things don't happen, what's the risk?
This raises an important question about consensus forecasts. The report notes that many analyst forecasts for these sectors actually predict continued margin expansion. Nuvama suggests this looks, well, challenging to achieve under the current conditions. It seems like a potential risk to those earnings forecasts. If margins can't expand much further, earnings growth has to come almost entirely from sales growth, which, as we know, is currently weak.
Which brings us nicely to how FY25 looks in the broader context compared to the previous year. The report calls FY25 a year of reconciliation. What do they mean by that?
Yeah, it's the year when some of the divergences we saw in FY24 kind of sorted themselves out, came back together. In FY24, there was a notable gap between different performance metrics.
Like profit and investment growing much faster than sales, that gap.
Exactly that. In FY24, PT and capex were growing at over 20% year on year. Huge numbers. While the top line was significantly slower, stuck around 8%.
Yeah, a big disconnect there. So what did FY25 reconcile? How did things come back together?
In FY25, the growth rates for top line, P80, the wage bill we mentioned, and capex, they've largely converged. They've all settled down into that roughly 8–10% range.
Ah, I see. So everything is moving more in sync now, but unfortunately it's syncing up around that relatively weak top-line number, that 8–9%, not the higher profit and capex growth numbers we saw the year before.
Precisely. That's the key point. The report suggests this convergence around a relatively weak top-line level is actually quite similar to the trends we observed before the COVID pandemic. Pre-COVID, corporate growth rates often moved in a tighter, generally lower band. The pandemic introduced so much volatility and divergence.
So FY25 felt more stable than FY24 perhaps, but also maybe less exciting, settling back into a pattern that feels a bit more like the pre-pandemic normal. Okay, let's talk about the small and mid-cap space specifically, SMIs. This has been a really popular area for investors recently. How did SMIs fare in this earnings cycle compared to the large caps?
Well, SMID profits, after significantly outpacing large caps in FY24, they basically converged with large caps in FY25. So that period of their earnings growing much faster than the big companies seems to have ended, at least for now.
Okay, so the gap closed in FY25. But here's where the outlook for you, our listener, gets interesting. Because market expectations for SMIs seem different for the coming year, FY26. What does the consensus forecast for SMIs?
Yeah, the consensus forecast is actually predicting a significant bounce back in SMI profitability compared to large caps for FY26. Analysts, on average, expect the smaller and mid-sized companies to regain that earnings outperformance lead.
But Nuvama, the authors of this report we're discussing, they question that forecast, don't they? Why are they cautious about SMIs regaining that lead?
They think SMIDs could potentially disappoint those high expectations because, well, as we've discussed, growth seems to be slowing down in a broad-based manner across the economy. This includes even some domestic areas that SMIDs often rely on, like slowing credit growth, moderation in auto sales, and maybe even real estate sales cooling off. If the overall economic tide is slowing, it's difficult for the smaller companies, generally speaking, to suddenly accelerate dramatically faster than the large ones.
And there's the valuation angle too, right? SMIs became quite expensive during a run-up.
Absolutely, yes. The report notes that the mid-cap valuation premium compared to the Nifty, it has moderated slightly from its peak, come down a bit,
Yeah.
but it still remains elevated relative to its historical average. It's still quite high. This high valuation poses a significant risk if SMID earnings don't actually deliver that consensus expected outperformance in FY26. If the earnings growth doesn't live up to the elevated expectations baked into those prices, the market could see a correction in their valuations.
So the street is betting on SMIs bouncing back strongly, but Nuvama is essentially saying, hold on, pump the brakes, look at the broad slowdown and the still high valuations. That outperformance forecast might be a tall order. That makes sense. Okay, shifting our gaze forward then, what does the report say about the road ahead for corporate India more broadly? What's the outlook?
The report describes the demand outlook as, frankly, uncertain. They detail several significant headwinds they see persisting.
Okay, what are the main challenges to demand that they highlight?
First, global uncertainty. While the global picture might be stabilizing somewhat, a strong recovery is, well, uncertain. They point to factors like weak global commodity prices, a contracting global PMI that's a key measure of manufacturing activity, and the potential for renewed trade tensions. This poses risks particularly for Indian exporters.
Okay, so external factors are definitely a concern. What about domestically? What are the headwinds there?
Domestically, consumption is seen as remaining under pressure. This links directly back to that slowing wage growth we saw in the earnings data. Less robust income growth naturally impacts household spending power. They also mention slower growth in consumption loans and possibly moderated wealth effects, playing a role like, people feeling less wealthy, perhaps, due to market volatility.
Right, and private investment, capex, is being held back by that weak demand, as we covered. What about government spending on infrastructure, government capex? Can that pick up the slack?
Well, government capex growth was actually weak in FY25, only growing about 5–7%. And the expectation, according to the report, is that it will remain subdued in FY26. That's partly as the government focuses on fiscal consolidation, managing its budget deficit, and also factors in potentially lower income tax collections.
Okay. So the key engines for growth, global demand for exports, domestic consumption, private investment, and government investment, all seem to be facing headwinds or expectations of moderation. What does this uncertain outlook mean for the consensus earnings estimates for the next year, FY26? Are they holding up?
No, earnings estimates continue to be downgraded. Following the Q4 results, FY26 earnings estimates were trimmed by another 2% for the Nifty Index and 3% for the broader BSE 500.
Downgrades are continuing, even after companies have reported their latest numbers.
Yes. And looking back over the past year, the FY26 EPS earnings per share forecast for the BSE 500 has been cut by a significant 10%.
A 10% cut in expected earnings for the coming year over the last 12 months? That's quite substantial. What's the consequence of that persistent cutting?
Well, the report states that this results in the one-year forward EPS figure stagnating, basically flattening out. This is a trend they note was also seen in the years leading up to COVID. It means that as time passes and FY26 gets closer, the market's expectation for earnings in that year isn't really increasing overall. The stagnation in the forward earnings forecast potentially caps the upside potential for the market itself.
Right, because the market looks ahead. And if that forward view isn't improving, there's less fundamental reason for stock prices to rise significantly. Yet what about the overall consensus forecast? The street, on average, still expects pretty strong growth, right? Despite these headwinds.
Yes, that's the disconnect. The average consensus forecast from analysts is still predicting a mid-teens earnings growth for corporate India. something like a 15% compounded annual growth rate for FY25 through FY27, or mid-teens growth for the Nifty, specifically in FY26 and FY27.
Mid-teens growth sounds quite healthy on paper, doesn't it?
It does. But Nuvama's view, based on all these factors, the persistent demand headwinds, the already high margins limiting expansion potential, the slowing investment, their view is that this consensus forecast looks like a tall ask, as they put it. They believe it's likely to be disappointed.
So the reality of weak demand and limited margin upside seems to clash with what the broader market is still hoping for or forecasting in terms of earnings growth.
That seems to be the key disconnect highlighted in the report, yes.
And all of this is happening against a backdrop of how expensive the market already looks. What does the report say about current market valuations? Are they supportive?
Well, despite the slowing profit growth and that uncertain outlook we've just discussed, market valuations remain elevated.
Elevated compared to historical levels.
Yes, the report gives some specific indicators. Market cap to GDP ratio. The total value of the stock market relative to the size of the economy is currently around 132%. That's considered elevated and closer to the peak seen back in 2007, which was around 150%.
So the stock market is quite large relative to the underlying economy right now. What about the Nifty's valuation specifically, like its PE ratio?
The Nifty's one-year forward PE, its price-to-earnings ratio based on expected earnings over the next year, is trading above its long-term average. In fact, it's even above one standard deviation from that average.
Meaning, statistically speaking, it looks expensive based on those forward earnings expectations, which might themselves be optimistic.
Correct. And they also compare the Nifty's earnings yield, that's earnings divided by price, the inverse of PE, to bond yields. Specifically, the Nifty earnings yield minus the average of U.S. and India 10-year government bond yields is currently negative at minus 0.4. This suggests that equities look expensive relative to bonds right now. Historically, a negative value in the spread indicates less relative attractiveness for stocks compared to fixed income.
Okay, so these various valuation metrics are all pointing towards the market being on the higher side, maybe even stretched. And if you connect that back to the slowing profits, the potentially optimistic consensus forecasts, and the stagnating forward EPS.
Exactly. High valuations amidst that kind of backdrop. It really does cap the potential upside for the market. There's just less room for prices to rise significantly if earnings aren't growing strongly to justify the current price levels, and valuations are already stretched.
Right. This whole valuation picture, combined with the earnings outlook, provides the context for Nuvama's recommended investment approach then.
Yes, based on their findings, Nuvama suggests investors maintain a defensive bias in their portfolios, and they specifically prefer large caps over small and mid caps right now.
Okay, why large caps over SMID specifically? What's the rationale there?
Primarily because of that potential for SMID earnings to disappoint relative to those high consensus expectations for FY26, coupled with their still elevated valuations we just talked about. Large caps, in their view, offer potentially more stability and defensiveness in an uncertain growth environment.
Makes sense. And what about their sector positioning? Which areas do they favor or perhaps avoid?
They are overweight, OW, meaning they recommend a higher allocation than the market weight in sectors they see as more defensive or resilient. This includes areas like consumer staples, private banks, insurance, telecom, pharma, and cement.
Okay. And underweight UW recommending less allocation on which sectors?
They are underweight on sectors that are generally more cyclical or face specific direct headwinds. That includes industrials, IT services, autos, metals, and power utilities.
So essentially tilting the portfolio away from areas highly sensitive to economic cycles or specific pressures towards those that might hold up better if growth remains subdued. The report also gives some specific examples of how these findings impact individual stocks or sectors, including rating changes and large earnings forecast revisions. Can you share a couple of those just to make it more concrete for our listener?
Absolutely, yeah. They made rating upgrades for stocks like, for example, ICICI Prudential, HCL Tech, and Tata Steel. On the other hand, they downgraded stocks such as Kotak Mahindra Bank, Wipro, and Root Mobile. So definite shifts there.
Okay. And what about those large earnings per share revisions? Where do they see big changes in expectations for specific companies after these results?
Yeah, some of the top upgrades in terms of revisions to FY26 EPS forecasts were pretty dramatic. Companies like V-Mart Retail seeing a massive upgrade of 113% in their forecast. Steel Authority of India up 38%. Shree Cements up 34%.
Wow, over 100% jump in the expected earnings for V-Mart. Significant upgrades. And on the downside, any major downgrades?
Yes, some sharp ones there too. The top downgrades included Shoppers Stop, down a very sharp 117% for their FY26 EPS forecast, essentially wiping out expected profit. Sapphire Foods, down 58%. Intrapress the Gas, down 52%. These examples really show the significant impact that actual earnings performance and the future outlook are having on individual company forecasts right now.
Those are huge swings in expectations for specific names, really highlighting that underlying profit churn and the uncertainty we talked about earlier. So to bring this deep dive together then, the recent earnings picture for Indian corporates, based on this detailed Nuvama report, it paints a story of companies navigating weak demand primarily through aggressive cost control.
That focus on costs led to a modest improvement in profits, yes, in Q4 and for the full year, but it wasn't fueled by strong sales growth. That remains weak and has been for 2 years now.
And crucially, this cautious approach means companies aren't reinvesting heavily in their future. Capex growth has slowed dramatically, despite healthy cash flows.
Exactly. Looking ahead, the report sees the demand outlook as uncertain, profit margins as largely peaked, and they believe the consensus earnings forecasts for FY26 are likely too optimistic, which potentially leads to continued downgrades and that stagnation in the forecast for earnings 1 year out.
All of which is happening while market valuations remain elevated, maybe even stretched.
Which, the report concludes, caps potential upside for the market and supports a more defensive stance, favoring large caps over SMIs for now.
Right. This wasn't just about numbers on a report, was it? It's really about understanding the underlying financial health and future potential of corporate India. And that impacts everything from job creation to investment opportunities for you. This deep dive, hopefully, gives you the key facts and context from the source to be well-informed about what's really driving things right now.
Yeah, it highlights the balancing act companies are performing trying to protect profitability when revenue growth is proving elusive.
Exactly. And here's a provocative thought for you to consider as you think about all this. Given that corporate India is currently generating healthy cash flow, but seems hesitant to deploy it aggressively into expansion, what does that tell us fundamentally about their collective long-term view on future demand? And what specific signal, what kind of shift in the economic environment do you think it would take for that crucial private investment engine to finally kick back into high gear?
That's a great question. Definitely something to think about.